circa April, we had this conversation wherein you had said that 2 event risks and 1 structural risk mean that Indian markets will give no returns. Thus far, it's proven to be exactly true. We are circa 17,600 then. We are circa those levels right now. What's your thesis now that's 6 months out or 5 months out?
So there are, what kind of makes me a little bit nervous, Neeraj, is that people look at the 5-year, 10-year promise of India, which is very real, which will come through, and then try price all of it in today for every stock. Right now, that is a bit tricky because not everything will succeed. You will always have businesses which do well and businesses that don't do well. But when you have this universal belief that, look, every stock in the country will be a multi-bagger, and you're starting to pay 100 times plus earnings for a variety of range. In fact, if you look at the math, 20% of India's market cap now trades more than 50 times earnings, okay, which is very punchy, these valuations. So the fear is not that the economic cycle might disappoint in the long term. The fear is that the market's creating its own cycles through this whole exuberance, disappointment, flip-flop that investors kind of go through. And that's in the context of global uncertainty on liquidity, global uncertainty on rates. That makes me very nervous from where the market is positioned. So I am under no rush to go and tell you that I'm reviewing my Nifty outlook to tell you that, oh, it's going to make you a lot of money. I actually would argue that this is a pretty tricky time from valuations perspective and expectations from markets, and you are unlikely to make too much return entering the market at these levels.